Hey guys, excited to be here for another week and this week in Pre-IPO. I'm your host, Evan Cohen, and I have Aaron Dillon, the founder and managing partner of AG Dillon and Company. I also have Nick Fusco, the CEO and founder of 8View, a pre-IPO data analytics company. We've got a slew of topics today. Some pretty big news. We have talked Reddit. We'll talk about later in the show. They just announced an IPO. But to kick off the show, we're going to talk about Anthropic and, more importantly, their Series B lead investor, FTX. For those of you who don't know, FTX was one of the largest crypto exchanges during the 2020 and 2021 crypto heyday. They had a venture arm which invested in startups, and one of the companies that their venture arm led was a Series B into Anthropic. They led a $500 million round in July of 2022 at a $4 billion valuation. Since that investment, FTX went bankrupt. They unfortunately had, I think, over $8 billion of creditor dollars tied up, in which they are going through a lengthy bankruptcy process to get those creditors whole. And as a part of that bankruptcy process, this venture arm is being liquidated. And they just got approval from the bankruptcy court to liquidate their stake in Anthropic, which has appreciated substantially. I believe the last time they raised was in late 2023 at around a $20 billion post valuation. So if they went from 4 to 20, this is a pretty big jump. So Nick, I hear you're hearing rumblings in the market that these shares are coming available. You also heard rumblings that Anthropic might be raising its own round. Tell us what you're seeing and what you think about the opportunity to invest in Anthropic and buy these shares off of FTX.
Sure. If we're going to flood the market with shares that are hotly anticipated in a segment of the market that's just equally going bonkers, this is great. And you're seeing that the trend observed with Anthropic is very similar to the trend observed with OpenAI, where it's really shot up significantly in the last 6 months. And then you started to see this trail off settle in that price. I think the rise in Anthropic was actually much more pronounced than what you saw with OpenAI in terms of volatility. So we're seeing that around an implied valuation of about 14 billion at the moment, with a fair bit of interest on the large institutional size lots. So lots that are more like your $10s and your $20 million size.
Sorry, so Nick, you're saying you're seeing them at a $14 billion valuation. So that's down from the $20 billion post they raised last year?
Yeah, I think the pitch book has them in at 20 billion. We were discussing that before the pod started. Like, what's the actual pre-money? And as if they keep doing these Series D rounds, D1, and then looks like they're out doing a D2 right now. At a $14 billion pre-money, then that number that you just said right there, Nick, would be spot on. I'm for what it's worth, I'm seeing them down based off of that December round at 18 billion, and they're down 17% from there. Right. That's your data, right, Nick, in the secondary market. So that puts them around 14.9 billion. But what's interesting is I'm out doing a trade right now in Anthropic, and I got several offers at that $18 billion number. And in particular, it looks like a lot of those shares are coming from FTX, and that's where they're pricing them at, is at that $18 billion round. So it looks like folks that are getting trades done at the 14.9 billion in the secondary are going to see a nice pop here as these new shares filter through at that $18 billion number. So that's going to be a nice little gain for people that got in the market here in the last couple of months at that lower price point.
So what you're saying, Aaron, is the people that bought between September and I guess last week, they were buying them around $14 billion. Now we're seeing these FTX shares hitting the market at around an $18 billion round. Is that going to close before this new round, or is this new round that they're raising going to be in conjunction
Good question.
with that?
I do think it seems like they're doing a primary round at the same time that FTX is outselling their shares too. So there's this secondary round happening and a primary round happening at the same time. So it'll be interesting to see. That's a lot of Anthropic for sale all at one time in the marketplace, right? Because my understanding is that FTX position is like $1 billion now, $1 billion plus.
It's gotta be
super
more than
intriguing.
That definitely hurts the primary round as well. If you're flooding it with supply, none of that FTX money is actually going to the company itself, right? It's all secondary. So
yes,
that's not brilliant if you're Anthropic trying to raise capital whilst this liquidation event is going through.
Yeah, that's rough.
So FTX invested $500 million at a $4 billion valuation. So let's say this thing is $16 billion. That's 4x. That's a $2 billion stake right here. That's going to go to secondary. Let's go back to
I think
FTX
there's dilution.
creditors.
I think there's dilution in there. I heard from somebody this morning that their stake's worth $1 billion. I saw in the press that they're at 8% now. So if it's an $18 billion valuation, it's 1.4. So yeah, there's definitely some dilution there, Evan. I think that's what's pulling them down on that.
Yeah, that makes sense. We talked about it before the pod, but then in September they raised $4 billion at the 18 billion post, and they added 2 billion at the same sort of valuation. So this company is experiencing a lot of dilution. Nick, do you feel that could lead, that's a red flag for investors, that this company is just continuing to dilute itself in effort to bring in more capital?
I think it all depends on the situation. In this particular case, I think I'd be okay with it. Understanding the growth potential, how rapidly the market is evolving, how much money is actually involved. We hit on this last week with the gross margins unknown aspect of things with OpenAI. These companies need significant funding. So if they're going to continue to raise, if it's any other company right now, you might bat an eyelash or question it. But in this particular case, I think that's super reasonable to keep raising over time to win the arms race, or at least be one of the top names in the ring.
Aaron, and it looks like you're working on a deal right now around this. When you're investing, you're going to put capital into the company today. What are you thinking dilution-wise around that stake over time? Because as Nick just said, these companies are going to need to raise a lot of capital. This is definitely not the last time they'll be coming to market. So do you factor dilution into how you assess investing?
Definitely. You've considered dilution 100%, right? It's hard to say. The dilution is a factor of like how much you raise to what valuation you're raising at. So if you look at OpenAI, their valuation, when it was in the single digits, and then it jumped up to 27, and then it was 86, and now it's at 100, right? So if you're raising $5 billion at $100 billion valuation, it's a lot different math, right? Than if you're raising $4 or $5 billion in an $18 billion valuation. So that's important. What's interesting is they're doing $1 billion in revenue as the forecast Anthropic for 2024. So right now, all these AI companies look like their valuation multiples are being applied to their future kind of forecasted revenue, but that's still only 18x. OpenAI is at 50x right now. So there's some room to run there. I think that's the investors that I'm talking to are interested because it's not at that 50x valuation multiple that OpenAI is at. So It's a great company. It's growing really fast. It's got great prospects, but you can get in at an 18x multiple. But I think to your point, Evan, it's like if there's going to be a lot more dilution in that, they're going to need to uptick that valuation here over the next couple of rounds to something much higher than 18. And somehow like they got to justify that. So revenue's got to grow.
And that makes sense. I guess you guys have been doing this a lot longer than I have. But at the later stage, at companies when they're raising $1 billion, $2 billion here and there, what is the typical dilution? Because these companies, typically if you're raising that amount of money, you're a relatively established business. You have real revenue, you have real customers. This money is generally used to like bridge you between when you're private and going public. It doesn't look like Anthropic is that stage. And like they raised $4 billion. They sold over 25% of the company. That's a real amount of dilution.
I think it's this AI. It just costs a lot of money to train the models, right? It costs a lot of money to service clients. I'm sure they're running at a per unit loss right now for every user that signs up. So it's an expensive game that they're playing. And I anticipate that's why they're pulling in so much cash.
Just a reference point on that dilution. If we're looking at a Delaware filing from a year prior, you're seeing it about like 1.4 billion shares. Then it goes to 1.55 billion shares. So you're really seeing anywhere from a little less than 10 to a little more than 10% dilution. I think what we're observing here is going to be definitely at the higher end of that buffer. But funnily enough, at a percent basis, that's not insanely different from your mid stage. It's definitely not going to be like the 30%, 20% you're seeing way earlier. But if they're just growing gangbusters, it's going to happen at a more rapid clip. And I think everyone has to be comfortable with having a smaller piece of a bigger pie. Plenty of these companies are actually profitable, not in this case, but enough are that they're not going to have as much dilution.
All right, so let's move the conversation over to ScaleAI. Nick, I want to point over to you because I know you and your firm 8View have done some pretty interesting research. So I'm going to let you sort of tee up this topic. What's going on over there?
Sure. ScaleAI is a technology company that specializes in helping folks train their models, right? The validation solutions, all that aspect of making sure we can pump as much data through to get a proper model as possible. So hence they're working with so many large corporates because good information is needed as the input. So when you think about good or volume of data, they're operating well in excess of 7 billion data points that have information associated with them to then create models. They've actually been around for quite a while. So 2016, I think 600 plus employees, and they've got just a set of very high quality customers like your Fortune 500 companies, and they are growing quite rapidly as well. They've grown anywhere from 180 million in 2021, 290 million in 2022 to $750 million more in 2023. So really enjoying the AI prime time right now.
I guess the question I have, just like digging into that a bit, is it seems like this company has been a slow grower compared to the rest of these companies. Do we feel like this is an underpriced asset that's going to hit that same market and play in the same space, or is this a totally different business?
Yeah.
I think this is more your picks and shovels, right? Over 100% growth rate in the last year. That's funny to call slow, but I get in the context of the other companies why you'd say it. This is not the technology changer, right? They're sitting on all the data that can be useful to train things up, like a Mechanical Turk or some of the others like Complement to Hugging Face. But they are not doing the same business as an Anthropic or an OpenAI, which really have changed the landscape as a whole.
So like these guys, interesting group of customers. Like they work with OpenAI Cohere as clients. The U.S. Air Force as clients. They got Microsoft, Meta. I mean, these guys are dialed in. So it is like a really great picks and shovels play. And so this is a really interesting company. I think, Evan, to your point, if you can get into a business like this at the kind of near that last primary round at 7.3 billion, I don't think it's unrealistic for them to double or be something close to that. 250 million trailing 12-month revenue. That was 2022. They don't have a 2023 revenue number.
So 2023, according to Sakra, is 760 million.
Yeah, so that's a lot of revenue growth.
So big 160% growth on that.
That's a great growth number.
Yeah, so if they're continuing,
it's no OpenAI or Anthropic, as Evan was saying, but yeah, it's looking good. And then price change wise, remember what we were saying about OpenAI, Anthropic, and the rest. All of those generative AI companies had a huge pop, and then they've come back. So AI as a sector, which we track at ApeView, is actually ever so slightly down. Data is up over the last 180 days by 12%. The broader ApeView 50, the most active 50 names, is up 19%, and ScaleAI is up 30%. So in terms of us looking back at those picks and shovels, which we've spoken about on many episodes, whether it's going to be Microsoft or the energy providers or companies like this, is really starting to show legs. So I'm pumped for ScaleAI. Naturally, I'm in that space as well. So data is valuable. It's necessary for training proper models, for data science teams, for everything. So I think the fact that they can also be agnostic in terms of who they work with is incredible too.
Nick, is this data considered proprietary data, or is their clients' proprietary data?
So my understanding is it could be both. So let's say that I wanted to load up my own proprietary data and work with that to train models. That's fair game. And then I could blockade that so no one else could have access. So if I don't want Michael Bloomberg to be looking at ApeView data at this point, then that remains in my walled garden. But also there's significant access to other public data.
That makes sense. I'm just trying to right size it in my head because we spoke a couple of weeks ago about Grok and XAI. And their moat was really the data. The data pipeline is really where people are using to justify the valuation. And Aaron, what was the valuation of XAI when we last saw it? I think it was 16 or 17 billion.
That sounds right to me.
Yeah. And so if the data is the thing that really makes it valuable, Scale has got to have a massive opportunity there, and that valuation should probably be justified down the line for it.
It's just an interesting business. Like Databricks is like this too, right? Where you're helping people take their own data and train an AI model. And that's like, I think, a super interesting business, because there's a lot, like, let's be honest, there's a lot of businesses out there sitting on incredible amounts of data. Like Salesforce kind of started to do this way back when, like this was their whole thing, like get data in a place where you like manage it and use it appropriately. And this is, I think that this is the AI version of that, right?
Are we seeing a lot of supply for Scale AI shares available, or is that the sort of thing that once it hits the market, it's like it's gone very quickly?
Actually, you've got a 40-60 rating ratio between bid and offer. You've got in excess of 100 million on both sides of the market for the last 6 months, and double that over the last year. It's pretty healthy. Wow. And not as large lot sizes as the rest. So your lot sizes are more like 1 million to 5 million range.
Yeah, very interesting. I think we're all in agreement here. It sounds like this is a really nice opportunity and not super expensive AI play, a picks and shovels play. And if looking at the index, it looks like a big opportunity. It's been carrying its weight in the index to making the whole market pop.
Yeah, I think anything in AI right now is probably pretty smart. Obviously, some are better than others, but there's going to be a run for a lot of these companies. So if you can get in at a decent valuation, these guys with this customer list is super intriguing.
Yeah, and with 750 million in revenue, they're definitely not going to get super diluted. They've got something they can really defend here on a valuation side. So there's like a pretty compelling investment opportunity. Nick,
I think
thoughts
it's
here?
interesting.
I think that they are less defensible from a bear perspective, but I also bet their margin is going to be way higher than most others because I don't think they're going to have as much compute on their data sets or as much effort going in or even headcount relative to some of the other shops. So there's your base case, they better defend their position. So things like those Fortune 500 are really good for that. But yeah, I think you have to have a balance between the latest and greatest new technology and something like this for infrastructure.
You know, do we think that this could potentially be the first IPO of an AI company? You know, they're in the market for a long time. They've got investors that are probably wanting liquidity at some point in the future. Could this be the first one?
I think it's hard to tell which one was going to go first. I do think if I was a betting man, I mean, Databricks is going to go before anybody. In fact, I talked to a developer over there a couple of weeks ago, and he said, quote, the only thing everyone's talking about here is when we're going to go. So, I mean, I think if there's going to be one that goes, it would probably be Databricks.
Yeah, I just want to draw a different comparison. Databricks has already done their Series I, and something like Scale is at an E. And at some point, you just have to do it. You have so many different parties at play. You have so many different holders. You've got to bring it to market potentially. But actually, if your cap table isn't terribly messy or just everyone's aligned, I do expect a lot of these companies to just maintain private ownership and find clever ways to produce tenders and do what something like a SpaceX has done, right? So you're accommodating everyone, maintaining the private stock market. Databricks is probably on the other side of that. They're going to go. They've already made themselves look more like a public company as well, given that their holders are going to be like Lincoln Financial and T. Rowe, Boney Mellon. That's really where you've tipped the scales and you're exposed to 40 Act funds and managers, and you just got to do it. And scale doesn't have
look, I would offer this. I think a big driver of when these companies that are going to go public is there seems to be plenty of liquidity in the private secondary market. So as long as they can keep, these tenders happening now on like a consistent basis for companies are super interesting because if you're a shareholder, you want to get out, there's opportunities to get out. And you can get out of your whole position in a lot of cases, like in a 6 months or a year, you're out. It's good. Mm-hmm. The only thing that I probably really motivate a company like a board or a CEO to really push to go out or get a lot of influence from their investor base to go is if they're not able to increase their valuation in the private market because these like really sophisticated investors are keeping their valuation down, where if they feel like, hey, if we go public, we can unlock this valuation pop in our stock price, or they just need a lot more capital than they're getting in the secondary market and they can't get it. So they're like, I'm at $100 billion valuation, like an OpenAI, and I need $20 billion. So you go out and you do like a 20% float or whatever the number is in 20 billion. Like you may not be able to get $20 billion from the private market, but you could probably get that in the public markets. But, I think to Nick's point, like tenders are super interesting. Like what SpaceX is just, it's like super controlled, like linear growth of their valuation of their business. And then there's pullbacks, but they don't have to worry about it because they're kind of depressing the valuation as it goes up anyway. So there's always this like pent up demand to get more because the valuation's kind of like just slightly behind where it could be, right? So it's very controlled. So if more companies can do that, if they kind of, I think it's super interesting reason to stay private,
Well,
right? If you can.
Transitioning to our final topic, which is a company that has been private has been private and been purchased over 20 years ago. We're going to talk about Reddit, which last week became published that they're going to be filing for an IPO at a $5 billion directional valuation, which is it's a 50% haircut from their last valuation, I believe, in 2021. Yeah. And I believe that was led by Fidelity. So we have an institutional asset manager that was probably playing in the market that they didn't really fully understand during the hype of ZERP when tech was really exciting. And Reddit they have 73 million daily active users. So it's certainly a very popular website. Yeah. They were actually acquired by Condé Nast 20 years ago for $10 million. And today they're going to be going out in an IPO at $5 billion. Condé Nast still owns 30% of that company, but over the last 20 years, they've raised substantial amount of dilutive capital where now they have large asset managers on their cap table. So what do we think about this? I want to hear, what are we seeing in the secondary markets with all those investors getting crushed? Aaron, what are you thinking here?
There's at least 2 rounds that I'm seeing. There was that August 2021 round at 10 billion post money and a February 2021 round at 5.89 billion post money. Those poor people got crushed. So Fidelity was that one round, and then Vi Capital, the earlier one in February. But I mean, Tencent was paid Andreessen Horowitz, Sequoia. So I don't know where these people have marked their books. Like, this is the thing that's wild, right? So like the $10 billion valuation comes out in August of that year. Do these guys all keep it at 10 billion? Like the Fidelities of the world, I know don't. Like they called Nick to get pricing for their marks. I think they have a more sophisticated approach, but maybe some of the VC firms might still have this thing on their books at 10 billion. So they're about for a rude awakening.
Yeah, Let me touch on that. That's a super important point. So if we equate that valuation to a priced figure, you saw Fidelity mark this at $61.79 repeatedly from August of 2021 all the way to March of 2022.
Okay.
Then the huge markdowns kick in. They go from that $61 over to the next month or quarter down to $39.
Wow.
And more recently, you're observing that new market $31. Okay, this is across the suite of the Puritan Fund, Mount Vernon, Advisor Series, select portfolios that they're in. And we're seeing it down at about just shy of 30. Wow. In the secondary market. So they have followed, but they've taken that pain in overnight, that big write down that you would have seen back in between March and April of 2022, just kept on coming down. So part of our value prop is that we can alleviate some of that pain to show that there are these write downs that have to be happening continuously as and when you could observe liquidity in the market and you could see price volatility. So hopefully we help solve that pain issue.
But Evan, we were talking earlier about like how they set this price. And my point to you is like, I think they set the IPO price on based on what was going on in the secondary market, right? But what's key about this, when you start to get players like Nick just said, like the Fidelities of the world, and they're now a shareholder in your company and they have to mark their position to market. It starts, and guess where the bankers are going to go on the IPO? They're going to go to Fidelity at T. Rowe Price and try and sell IPO shares to them. So like, if they're like, look, I'm already a shareholder and this is how much it's worth. Or if they go to T. Rowe Price and T. Rowe Price is not a shareholder and they're like, well, Fidelity's got it marked at 5 billion, guys. Like, that's the IPO price. It's it's circular.
I understand that, but I guess where I struggle is how is that $5 billion valuation determined? Because unless someone has material non-public information on the revenue numbers, which were just published with the S1, but weren't necessarily available to anyone that's not on the board beforehand, like how are they determining 5 billion? Clearly Fidelity has a valuation methodology, which they must publish as a part of their compliance requirements to determine that share price went from 61 to 39. So they have to have some valuation criteria in there with metrics based. Now, the $5 billion number that you're seeing on whatever, Setter Capital, Forge or whatever, like that could be from thin air. That could be someone with weak hands needing liquidity to go buy a home or send their kid to college. And so is that the right number really to price this thing on? And that's what I'm curious, like if the bankers on Wall Street are using someone with weak hands' ability to sell as the valuation for an IPO, like that seems concerning.
No, I don't. I wouldn't categorize this as like small little tiny trades that are going off. I mean, a lot of these secondary market trades are like 5, 10, $15 million tranches that are being sold. So if something trades $15 million tranche and it trades at 5 billion, that's the price. I mean, like, you're not wrong about like data rights, but trades that happen between two people on the cap table, there's trades that don't happen that way. But there's something to be said for, there's a buyer and seller. Like, someone just bought these shares for X price. Like, that is a fact that happened, whether that was an educated sale or not. And then if everyone in the market starts to lock in around that price, I don't really think it matters what the fundamentals are. Like, that's the price. That's what makes a market. It's the same way where you get NVIDIA stock at huge multiples like this, right? No one would ever look at their fundamentals and be like, that stock should be worth this, but it is.
Well,
and people are buying and selling it at that price
all the time. I mean, Nick, what were you going to say?
No, but it's true for a lot of stocks. That's just how markets work, right? Sometimes it makes sense and they're rational, and sometimes they don't. But it doesn't mean that it's not true. It is what it is. Fair. You know.
Yeah, the point that I agree with on this with Aaron is we're seeing a $500 million of activity over the last year for this particular name. That is trustworthy, I feel, in the secondary market. Where I think we draw the line, and where if you really stop using the data that's rolling through, is retail.
Yeah, that's smart.
So you're right. Point. If you've got a second year developer that's sitting on $50,000 worth of shares, that is not where we want to have Fidelity rewrite their valuation.
Yeah.
And folks like them, they may actually not publish how they're arriving to that valuation, but I would say in a lot of cases, they're going to have an internal valuation protocol committee. They're going to walk through that. They're going to have an external valuer that is going to be an independent third party that's doing a lot of a bottoms-up analysis, whether it's going to be a discounted cash flow, looking at revenue or EBITDA multiples if possible, looking at public sector comparables, where that last round is, how their revenue has changed or their growth has changed since the last round. You are looking at a lot of data rolling into this. And some firms weight certain aspects more than others. But ultimately, I feel as though the secondary market on this, because it is so active, is important not to discount. And some of those methodologies didn't discount it a year ago. So for instance, like a Fidelity, if they did a 50% haircut from 1 month to the next, they might not have really taken into account as much of the activity in the secondary market. But it's also interesting what we're observing here on this relative to some of the names we talked about before. We talked about Databricks. They've got about 54% of their 90-day bid offer volume in offers. If you're looking at, we talked about Hugging Face is very similar. And then you start looking at this particular name, it's 97% offers.
Exactly.
It's just,
this is what
everybody's trying to unwind this. So you have to also take that into account, where offers actually should not be observed as reliable as bids, but they become more reliable the more you get and the more consistent they become, because ultimately that's where you start to find that market clearing price that Aaron spoke to, right? But they have to be institutional size to be trustworthy, I feel.
Yeah, I guess that was the point that I was going to make, and you sort of validated what I was going to, my own defense here, is that at the end of the day, you have an institutional asset manager that is holding an asset that they believe is going to be worth less tomorrow than it is today, which is why they are trying to sell it, which is why what you just said, Nick, is that there's a bunch of money trying to sell this asset. Also, you have to look at the opportunity cost. You have a massive secular trend in AI and VR and AR, and a lot of this is the time to be deploying capital into those businesses that are quickly getting inflated on price. So you have to look at the sector itself and the sellers and look at who those people are. And you're like, you're $15 million trade here, $10 million trade there. You're not wrong. Those are institutional sized trades, but like, who are on both sides of the trades? That's the better question. And are the sellers the smart money that are sitting to say, look, my $15 million of Reddit, I probably think it's worth $10, but I could probably sell it for 12 a day, and I could take that $12 million and deploy it into ScaleAI. That's what I'm going to do, because that's what smart money, sophisticated money does. Just to your point, Aaron, about what we're doing in the public markets with like NVIDIA, it's smart money. There's also retail, there's also ETFs. It's a totally different market. But I guess what I look at here, that's what we'll find out when they do go IPO, is that at the end of the day, I think we're all, at least I believe that this $5 billion is overpriced. When this goes public, the first 90 days, I fully expect the valuation to be less than $5 billion.
I would hedge. If you're in an SPV, not investment advice. if you're in an SPV that owns Reddit and you're like a doctor or a lawyer or a dentist or whatever, you should call your financial advisor and talk about hedging that position with something. NASDAQ futures, something. You know?
Exactly. And so the smart money that is holding Reddit shares, and they bought them at 10 billion or 5 billion or other, realizes that that is likely the outcome, and they are selling today to get out of that because the cost of capital is better used elsewhere. And so I don't think I don't know if I believe that just because you see 10 and $15 million blocks of a trade necessarily determines that that's the right way to value a company. In fact, that's what the public markets will do when they go out.
Oh, I agree. I agree with you, but that doesn't listen. I think there's this thing there. We can all put our CFA hats on and talk about how much a company's worth, and then it's like how much are people actually buying and selling it for. So, look, for what it's worth, I'm a big believer in the markets. I see people bring out spreadsheets and talk about all this other stuff. You know what it really matters? It's like buyer, seller, a trade happened. That's real life, right? In fact, when I was running ETFs, and we would have a liquid securities, small cap stock of liquid securities, things that don't trade. Guess what? We always went back to an actual trade that happens, regardless of size. Like that happened, it traded hands, it's worth that much today. So there's something to be said for real dollars crossing hands, regardless of size. And it's a point to it's something back to and say that's like a real thing that just happened. Someone bought and sold that stock for this much money. Talk about whether that's material or immaterial, right? Or if it's realistic or realistic, but it's really important when money actually trades hands.
So I think, Evan, you're bringing up really good points that are relevant if you are a stock picker. But I'm not going to say that most mutual funds are meant to be stock pickers, right? And this is why Aladdin has such a massive business through BlackRock, right? They are all about being able to appropriately diversify a portfolio, really good at looking at your portfolio attribution. So you're not just saying, oh, look at AI, it's killing it. Let's all hop on the bandwagon and go for it and unload Reddit because Reddit and Meta and YouTube, Twitter, Snapchat, they're all going by the wayside. I think this is very much about a portfolio attribution play that is important just to get it priced accurately. And I don't think you're going to just see people dumping this thing immediately unless we're starting to realize that the fundamentals are quite horrid. But in this particular case, you're seeing them have a steady growth in their revenue. It's trailed off from 21 to 22, I believe, but it's still well in the double digits. So I think this is what folks are going to want to understand and know if this is a good thing. Comparing it versus its peers, like how's it versus TikTok or how is it versus Instagram and those, that's probably more important than comparing it against the next OpenAI. Just putting that context out there, judging from what we're observing, I half expect you're going to see a sell-off and not a very strong IPO as well. Yet they're doing some funny marketing strategies. I think they're trying to get the top 75,000 Reddit users to own some shares or preferred prices. Do either of you know about this? Because I'm not a Reddit guy, so I'm curious if you two know about it.
They're offering the 75,000 top moderators, the people who, this is a user-generated site, they're offering them the opportunity to participate in buying shares prior to the shares hitting the market. Which you can do, I mean, they're also going to offer it to Robinhood users and SoFi users. A lot of these like retail platforms actually allow this to some extent. We've seen, I think Instacart was available, Duolingo was available. This has happened before, but it's a good way to incentivize people who have built this company over 20 years as users to be incentivized to continue to stick around and hopefully make sure this thing grow.
I love the irony of this is like one of the biggest things that Reddit was known for in our community was like the AMC, GameStop type activity, right? And encouraging the short squeeze. Yeah, they're just trying to get people to rally around so people don't beat the living daylights out of the stock, I think, which could very well happen. And then maybe get some vocal minorities to be pumping it up. So yeah, I've got 10 shares of this thing at $10 or whatever it is. And it's going to the moon,
right?
I don't know how many to the moon memes we're going to have to see on this, but maybe it's a protection or natural hedge way.
Why not?
In the social.
Let them buy diamond hands, the whole thing, right?
But
never sell.
Yeah, diamond hands, exactly. This might augment reality to bring that across.
I will say this though. So they sold their data to Google, $60 million a year. That's
Yes.
interesting. Okay. It's an $800 million a year business in 2023. I mean, that's material. You start to sell that to a couple other places. I mean, you could be doing $500,000 a year of data. And I got to imagine, I mean, I don't know if that's all the data, if there's a bigger one-time check to get all the history, and then you pay $60 million a year to get all the new stuff too. Like that's what we used to do at FTSE Russell when we were selling data, right? Like we used to sell, all right, well, you want the history, that's one price, and you want all the new stuff coming forward, it's another price. There's a lot of different ways to sell data and to monetize that. And that's obviously all dropping down to the net income. There's no cost associated with that, right? I mean, you're already running your business. And now you just package up this data and sell it. You got a couple salespeople. I mean, like it's not that expensive to run a business like that. So like that could be interesting. They start to take Reddit and they make it into like an AI data play. They're selling this to Google and 50, 60 other people. You know, now that's a business with a much different net income profile than what they currently have today, where it's like advertising driven.
Yeah, I just wonder how much data that will be, because it's going to pale in comparison to Scale. It's going to be like what X has with powering Grok. So because if you're looking at it, and I got some stats from Insider Intelligence, the amount of time spent on average across social media platforms, Reddit is the lowest end.
Oh, really?
You're spending like 23 minutes a day, but it's all good content that could power up LLMs, right? So 23 minutes on that versus a half an hour on Instagram plus another half an hour on Facebook. So that's an hour on Meta. You've got a little bit more on Snapchat. Twitter is 35 minutes a day. YouTube 45. TikTok 45.
Yeah.
So
makes sense.
It's at the lower end, and I believe it is trending in the wrong direction. And that's another reason, just get this thing public, right? Somebody's going to hold the bag. And that's aligning with Evan's theory on a bad IPO.
We're talking about a business that burns $900 million a year and doesn't have really even a mobile app that's functional. Like I find this to be very challenging. When I look at technology companies, and I look at operating a business, I look at their competitors, and I look at social media. Reddit, it feels like Craigslist. It feels like Craigslist, and Craigslist is run by like 30 people. And when I look at the business and I'm saying they generated $830 million in revenue here, but they lost $90 million last year. And I'm like, how is that even possible? Yeah. Like that seems like a very inefficiently run business. Mark Zuckerberg would be pissed. Elon would be irate. And so I'm looking at a business that's losing money. I'm looking at a bunch of insiders who are trying to sell. I'm looking at a business that's selling their data for $60 million a year, but the value of that data becomes less valuable as they sell it to other people because it's no longer exclusive. And it's not generating that much new data. So, I mean,
there's a lot of for me. A lot of what you're saying, though, sounds like there's opportunity to drive. You get the right group of people in there, they could drive a lot of margin pop, right?
You just described when Elon bought Twitter.
Yeah, exactly.
Right? Is he going to roll over there with a kitchen sink or whatever he did and try to?
That would be funny if he bought Reddit.
That'd be amazing. I'd love it.
I thought about that because I thought for $5 billion, this is a nice prime acquisition target. Google's paying $60 million a year for the data. They may as well just buy the whole thing for $5 billion and not have to. Then they have the exclusivity toward it.
Listen,
but I wonder if because they're going IPO because there's lick-pref and other weird ratchets in the deal, and IPO is the only way for the smaller investors to make any money. There's got to be some weird stuff in there, which also makes all of the late-stage shares very toxic, in my opinion.
Well, this hasn't happened in a long time, but people do buy companies off of the stock market, right? That doesn't really happen in tech. Tech companies really don't just buy something off the stock market, but my father used to work at Georgia Pacific, and the Koch brothers bought that off the stock market. Georgia Pacific was not a small company. Like Koch brothers literally called their broker and were like, buy all the shares. They didn't call management. They just like started buying shares. And next thing you know, they had like 50.1%. We own the company. So like that, with all of this data, with all the AI stuff around it, like to Nick's point, like, just go buy it. Why do you need to talk to anybody? Just start buying shares.
Yeah, and I think Evan's right that the fact that it will IPO first is a very different outcome. So if that was to be bought today at the exact same valuation, everyone's going to be pissed and walk out of the company. Well, it would be totally different because their equity's worth nothing.
Yeah, because the press. Yeah. I mean, think about the press for the two from 2021. Like, it'd be totally different. It'd be totally different. Common shareholders would get crushed. So
yeah.
actually good
Correct.
for employees if they own shares. At least they'll get something.
All right. So I think just to round this out, we're all negative on the Reddit IPO, although Aaron, it sounds like you're bullish potentially long run with some data plays in there.
And Nick, they get the right management team in. I think to your point, they could right size the expenses and get some data plays, and it could be attractive.
Nick, last word on Reddit?
I'm going to agree with Evan. I'm going to put a negative sentiment on this, barring a decent restructure like Aaron might describe, or they just meme the living daylights out of the stock and something positive happens. But I wouldn't,
I love it.
Like, barring that, I wouldn't, I'm not buying it.
Okay. Well, Nick, I'm not going to lie. I was very negative on this until you said that. And now you said the whole meme stock thing, and it makes me want to be very contrarian about this.
Evan's going to buy some options.
I might just buy some options on this thing. But anyway, guys, another great episode in the books here for this week in pre-IPO. Thank you guys again for joining me here. I got Aaron Dillon, the co-founder and managing partner of AG Dillon & Company, and Nick Fusco, CEO and founder of 8View. Thanks, guys.
Thanks, fellas.
Talk to you next week.
See you now.
Cheers.
Thank you.
Cheers. Cool.